On October 28th, global markets found themselves ensnared in tension due to the ongoing Israeli-Palestinian conflict. This escalation prompted a decline in investor risk appetite and a surge in risk aversion across international markets. Simultaneously, the prices of gold and crude oil experienced a sharp increase, while U.S. stocks and the U.S. dollar faced a decline. This situation highlights the intensification of the Palestinian-Israeli conflict. Concurrently, the latest data reveals persistently high U.S. inflation, raising concerns about the government's ability to reach a budget agreement by November 18th. This scenario exposes global markets to heightened risks. The rising tensions in the Palestinian-Israeli conflict have raised widespread apprehension on Wall Street. This event has now overshadowed the Federal Reserve's expected interest rate hikes, becoming a more influential factor in financial markets. The latest estimate for one-year consumer inflation in the U.S., sourced from the University of Michigan, has been revised upwards to 4.2%. Nevertheless, the response to this trend has been a decline in the U.S. dollar index to its daily low. The geopolitical complexity of the situation is expected to further bolster gold prices, while global energy markets face the risk of price surges, instigating fears of runaway inflation in the U.S. This would significantly impact the already fragile U.S. Treasury market. Notably, on 43rd Street in New York City, the U.S. national debt clock shows real-time updates of the total U.S. debt. As of October 28th, this debt had soared to $33.7 trillion, representing an increase of $1.4 trillion over the past 3 months. Yet, there are no concrete plans to pay down this debt. If the Federal Reserve increases its benchmark interest rate beyond the projected 5.7%, interest payments will skyrocket to a staggering $2.35 trillion. These figures could worsen if the U.S. encounters a debt crisis in 2024. Clearly, in an environment where the Fed continues to raise interest rates, such a substantial debt burden heightens the risk of the U.S. defaulting on its debt, potentially triggering a U.S. debt crisis that may ultimately lead to a depreciation of the U.S. dollar. When global central banks are at risk, the process of repositioning the dollar becomes imminent. While the U.S. Treasury and the Federal Reserve express confidence in their ability to safeguard the dollar's position and value, history reminds us that they cannot exert control over every aspect, especially not the generation of gold. The Israeli-Palestinian conflict may accelerate the world's pursuit of alternatives to the dollar, potentially hastening the process of dollarization. Furthermore, the U.S. government has floated the idea of returning to the gold standard as a safeguard to maintain trust in the dollar. U.S. Congressman Alex Money, a staunch advocate of the gold standard, has recently proposed H.R. 495 with the aim of restoring the dollar's value and status. A striking facet of Money's H.R. 495 proposal is his caution that a U.S. credit crunch could lead to more U.S. banks facing crises, further eroding the dollar's status as the linchpin of the global financial system and commodity markets. This could undermine the consensus regarding U.S. treasuries as the anchor for global asset prices, potentially triggering a dollar crisis and pushing the U.S. economy onto a rapid path toward recession. Such an outcome would likely result in a sharp decline in global confidence in the U.S. currency. In parallel, Switzerland has been expediting gold shipments to China. Switzerland, the second-largest physical gold market in the West, and the world's largest gold refining hub, has witnessed a significant uptick in China's imports of Swiss gold, rising by 68% year-on-year since the beginning of the year. Within the initial 9 months, Switzerland has exported a total of 536 tons of gold to China, marking a 24% increase from the same period last year, reaching the highest export volume since 2018. Additionally, China imported 119 tons of gold in August, up by 15 tons from the previous month, according to the World Gold Council. This brings China's total gold imports to 1.7 tons from major gold markets in Europe and the United States. During the initial 8 months of this year, a period anticipated to mark the most robust quarterly performance since 2015, recent data from China's customs and central bank reveals a noteworthy trend. China has consistently bolstered its gold reserves, with September witnessing an addition of 26.1 tons in August, an increase of 20.8 tons. This consistent accumulation positions China as the world's foremost purchaser of gold. Remarkably, this marks the 11th consecutive month in which China's central bank has amplified its gold holdings, commencing this trend back in November of the previous year, thereby augmenting its cumulative holdings by approximately 243 tons. In amalgamating data from China's central bank, the World Gold Council, and Swiss customs, the total gold shipped from the primary international gold markets in Europe and the United States to China since last November stands at 1,796 tons. Given China's accelerated endeavor to reduce its U.S. debt and foster the process of dollarization, analysts speculate that the actual quantity of gold acquired by China might even exceed these figures. This surge in gold acquisitions has sparked intrigue, with conjecture swirling about China being a significant, enigmatic buyer of gold reserves, actively aiming to mitigate its exposure to the dollar and U.S. debt. Notably, according to the U.S. Treasury Department's International Capital Flows report, China has consistently and sharply reduced its holdings of U.S. debt, with a substantial decrease of $16.4 billion in August, bringing its total down to $85.4 billion. This marks the fifth consecutive month of reductions, highlighting that China has been steadily diminishing its U.S. debt holdings in 20 of the last 22 months. In particular, China has notably expedited its reduction of U.S. debt holdings over the 12 months leading up to August. Over the past decade, China has markedly reduced its position in U.S. treasuries by 37%, orchestrating a net sell-off of $14.6 billion in U.S. debt. This shift has relegated China to the status of the world's second-largest overseas creditor. The current data underscores China's gradual divestment from its U.S. debt holdings. U.S. Treasury Secretary Yellen has voiced apprehension about the stability of the U.S. deficit and national debt in a recent media interview. She emphasized the substantial fiscal challenges confronting the United States and stressed the urgency of taking preventive actions to avert a potential fiscal crisis, especially in light of escalating tensions in the Israeli-Palestinian conflict. Yellen pointed out that high interest rates could strain the government's finances and lead to substantial losses. The looming risk of another government shutdown compounds the issue, prompting Yellen to call on Congress to swiftly pass a budget deficit deal without delay. She further highlighted that interest payments have surged more in the past 3 years than in the previous 5 decades. Jamie Dimon, CEO of J.P. Morgan Chase, also expressed deep concern about the state of the U.S. financial system, warning that the current circumstances might be one of the most perilous periods in decades. Today, the unsustainable U.S. debt looms ominously, casting a shadow over the dollar, particularly as it becomes more pronounced in the context of potentially triggering runaway inflationary expectations. This concludes today's video. We kindly request you to consider liking, subscribing, and activating the notification bell to stay informed about developments in business, economic history, international relations, geopolitics, and world affairs that influence the global landscape and our civilization. Thank you for watching, and we eagerly anticipate your presence in our upcoming content.